Hi, everybody. Kathleen here from XTB. It's a beautiful sunny day in London, but there were some storm clouds over in Westminster. Rachel Reeves has just announced her spending spring statement, so it linked to a lot of spending cuts. So we're going to go through that. We're going to show you some charts. I'm going to show you some charts now, if that's possible. Great. Now, guys, I'm going to show you, this is the pound versus the US dollar. Ahead of today's spring statement, we had actually seen some weaker than expected inflation data. So inflation had moderated by more than we expected for February, and that weighed on the pound early doors. So the pound is trading about 50 basis points lower, about 50 pips, sorry, not basis points, 50 pips lower on the day. That was mostly driven by the fall, as you can see, in kind of the middle of there, so just about 7 o'clock, 7 a.m. That was the fall from the CPI report. And then since then, tried to stage a recovery, but it really hasn't. So we're below that key 129 level. Now, I just want to show you 10-year UK gilt yields. I'm just going to bring up the chart. Obviously, any kind of fiscal event, spending review in the UK, you've got to watch the spending. You've got to watch gilt yields in the UK. As you can see here, gilt yields have risen about 5 basis points. Now, to put that into some comparison, as you can see, this is the, let's go to the 2-year quickly. So 2 years are actually falling slightly. 10-year yields are rising a bit further. So that hasn't quite been updated. But as you can see, we have seen a little bit of a surge in 10-year bond yields. If I zoom out, then you'll be able to see it in some context. 10-year bond yields are moving higher. Now, they've been trending higher this month anyway. That's down to growth forecasts. But what can we look at here? We're going to look at Euro GBP as well. Sorry, I forgot about that. Euro GBP, never one to forget about. Really interesting pair. As you can see, again, reflecting general pound weakness today. And the Euro GBP has moved higher a little bit. I want to show you this chart. Zoom out on Euro GBP because it is really interesting. As you can see on the far right-hand side there, we have got this kind of gap higher today. So if you look at the green line, now that's the 50-day, that's the 100-day moving average, sorry. We had found really good support there yesterday. That came in at 83.30. Now we've bounced off that level. So that acted as a really strong support level, suggesting we weren't going back to those lows of early March. And instead we've now risen above the 50-day moving average. Now we need to get a daily close above that level. That comes in at 83.55-ish, currently trading 83.66 on Euro Sterling. The next key level to watch is 83.80. So all these moving averages really come close together. That's because we're in a bit range bound. So if we can break above 83.80, maybe even 84, just to be sure. If we can close above that level today, that's a bullish development for Euro Sterling and suggests that we could move higher. Now, for those of you that watched our, I'm going to just keep that there on the bond yields, and I'm going to just bring it back to what we're doing on a tick-by-tick basis so that we don't miss any big moves. What I spoke about earlier was that there had been some negativity around the pound leading up to this meeting or this spring statement. And the reason why is because weaker growth forecasts, the OBR did slash the growth forecast for the UK to 1% from 2%. That was really well flagged, so completely expected. Borrowing is also expected to be quite stable, but net debt positions are expected to come down. That is weaker than expected for this year, but then it's expected to rise a little bit. Now, what you should remember is back in October, Rachel Reeves announced that she was going to change how we measure debt. So actually, it probably is still higher than what it would have been under the old debt measuring regime. So even though it looks better now, it is quite high. So I think the bond market is saying we don't buy all of this. We're still just on it. But bond yields are coming down a little bit now. This is the 10-year yield currently at 4.76. It had been as high as 4.78 earlier. It started the day, or bit ahead of the spring statement. It was around about 4.70-ish. So we've seen a mild move higher in bond yields on the back of this. I wouldn't say it's been caused any big shock. If you read our note this morning, hopefully you did, you will have seen that, I did say that any fiscal event in the UK, any spring statement, it does bring out kind of the bond vigilantes. Everyone's very interested in it when you have a big deficit like we do, and when you have high levels of government debt and quite low growth levels. So we did expect a little bit of a pop higher in UK gilt yields, but we think that this will be temporary. And the reason why is because, yes, the growth forecasts have been cut quite sharply. That's cut in half for this year. But that is in line with kind of global norms. And actually the OECD's forecast, that's another organization that is not linked to UK government, stands completely independent from governments, that they have, they gave out their forecast for G7 economies just 2 weeks ago. And they actually see the UK performing the second strongest performing economy this year and next year, just below the United States out of the G7 economies. So actually the OBR's forecast is pretty negative. Now, I think they're lowering that bar so that they can jump higher, jump over it, and can, you know, our growth rate, the economy, UK economy, can actually clear that bar. It does make it a lot easier. The problem with the growth forecast in October is that they were too high. So it was inevitable that they would be revised down. The other thing to point out, the welfare cuts that we have spoken about, and I'm sure you've read about lots and lots, you don't need me to go through them, but they are going to give the Chancellor back her fiscal headroom, which is just below £10 billion. However, by still only maintaining that very slim fiscal headroom, remember, fiscal headroom is really important because if growth is weaker or borrowing costs rise or you get some unexpected event, it means you have less to spend and you have to borrow more. But by having that unchanged fiscal headroom, it means that she remains a bit of a hostage to fortune again. So if the UK economy surprises on the downside, even more so than the 1%, than the 1% growth forecast for this year, or if we see a spike globally in borrowing costs, for example, that's not even the UK's fault, that could still mean that she has even less headroom when it comes to the October budget. So that's really interesting. Absolutely no tax rises here, nothing to report that was not already well flagged. I think this was a very well managed, actually, spring statement from Rachel Reeves. The bond market, I think, will ultimately like the spending cuts, because it means that even if they kind of don't cut spending, but at least take out the waste and the unnecessary or the spurious disability claimants or whatever else that might be, then I think the bond market is going to like that, because that will save a hell of a lot of money. Just talking to some very well-regarded analysts, that runs into the hundreds of billions of pounds every year. So we could really see some kind of benefit there to the UK economy just from doing that, and that could reduce bond yields and reduce the UK's borrowing needs. And as you can see, bond yields are falling now. So that initial spike higher, as I said, very, very temporary. We actually think this is a positive budget for the UK's financial position. I think it's going to have a positive effect on markets, definitely compared to the budget in October. And this should give Rachel Reeves some time to think. The bond market, financial markets, they react well to overall, they don't react very well to tax cuts at all, particularly when growth is so weak. So unless we see growth absolutely power ahead, I don't think we're going to see tax rises anytime soon from this government. And instead, it will be very much focused on bringing growth under control, bringing debt under control, cutting wasteful spending, spurious disability claims, etc., and also trying to boost overall economic growth. But I'm going to leave it there. Look, I'll just leave it on the last note. 10-year borrowing costs right back to actually lower than they were before Rachel Reeves started speaking. So she's done something right. The bond market hasn't been out to get Rachel Reeves so far today. But thanks everyone for joining, and we will speak to you soon.